In this final video on discounted cash flow, and in particular talking about capital budgeting, let's talk about some, I like to call them curveballs, right? Things that are applications that may put a little kink in our understanding of a project and might require us to adjust things, if you will. So the first thing we want to talk about is something called the equivalent annual cost. Well, essentially, this is a question, an example of a project where, in this case, again, we wanted to buy this container pier. So it was going to cost us $40 million. But what would happen if we could lease the asset instead of buy the asset? What would the lease payment need to be? What would the maximum lease payment need to be for us to say, I want to lease instead of buy? So it's a payment question. And what we want to do is to convert these cash flows, the value, into a equal payment stream. So the rate, again, annual rate's 10%. It's 12 years. We're assuming a 12-year life. It's going to cost $40 million. And we're assuming that at the end there's going to be $4 or $4 million left over. So that tells us the answer here is $5.68 million. So if our lease payment would be $5.68 million or less, we should lease the project. If the lease is going to be more than that, then it's less expensive to buy. Now, you also could do this if you are comparing a couple of projects. Let's say they are mutually exclusive projects. They both do the same thing, but one has a 3-year life and one has a 6-year life. Well, it's not fair to make comparisons of things that have vastly different lifespans. So what you can do is calculate this equivalent annual cost, and it will convert the net present value into this annuity. So what would be the difference? The rate is whatever your cost of financing is. The number of periods is the periods for that project. Present value would actually be net present value. Future value is 0. The type is 0. That will give you this equal annual cost. And then you compare that to the two projects. Now, in this case, we're taking the value and looking at it as if it came in equal amounts. So you would choose the project that had the greatest equivalent annual, in this case, they call it cost, but it's the equivalent annual annuity. We had mentioned mutually exclusive projects just in this last slide. So again, the purpose here, or the idea is, how do you choose? When you have more than one choice, what do you do? And of course, as they mentioned here, there's more than one way to achieve an objective. So mutually exclusive alternatives imply we have 6 things that we would like to do. They're all the same thing. They have different values, different investment costs, different expenses, right? So they all have different cash flows. How do we choose the best one? So we have to rank them. When investments are independent, that is, they're all by themselves, doesn't matter which technique you use, net present value, the internal rate of return, or the benefit cost ratio, they'll all give you the same answer. The challenge is, because of the differences in mathematics, they're not going to rank projects the same. So what do we need to know about this? Remember, net present value always gives the correct answer. However, managers really like the internal rate of return method better. Why? It's just easier to understand. Capital rationing is the process when management imposes a limit on how much money we're allowed to spend on projects. Again, we need to rank these projects. However you do that, you do that. But the idea here is that since we're altering the ranking, we're going to get different combinations of projects. But the big point here is this project can create a situation where we limit the projects and possibly give up some perfectly good assets. Perfectly good assets meaning assets that create value for the company. And we never want to leave money on the table. So in perspective, what about this internal rate of return thing, right? It has more intuitive appeal. The challenge is it has some issues. And it's beyond this course to really talk about all of those issues. But suffice to say, management likes it better than net present value. It can give us some different answers, though. So if you, again, maybe in future videos, we'll discuss this in a lot more detail, but you could have multiple answers. You could have no answers, right? There's lots of outcomes that can come with the internal rate of return that really won't help our decision-making process. So we just need to recognize that the internal rate of return has some issues. So what do we know about the cash flows of our projects? Now, we're not going to get into a lot of detail here, but there's two principles that we need to understand. Number one is we need to understand that we need cash flows, right? So we need to forecast when we think those cash flows will actually occur. We need this for the time value application. But when you're talking about projects, we also have to talk about what they refer to as the with and without principle. Essentially, this requires us to make two predictions. We need to predict the cash flows that we think will happen if we do this project. But we also have to predict the cash flows if we think we won't do the project. So then you subtract them. What this creates, and I didn't write this down, but it's what's referred to as the incremental approach. You take what you think you'll get if you do it, and you subtract that from what you think you'll get if you don't do it. So in this case, we're only analyzing the differences. It gives us a much cleaner representation of the actual increase in value of a project. So if you think about an income statement, this line would be the prediction. This is what we think will happen if we do it. On the other hand, over here, we would then have a prediction of what would happen if we don't do it. Operating income will probably be the same, but operating income will probably be different because we don't have a new asset or we haven't changed the process. But regardless, in the end, we will take what we think will happen, you subtract what will happen if you don't do it, and the actual analysis is on that difference. And that might seem a little bit complicated, but in future videos, we can talk about how managers ultimately do this so that they can make good decisions. A couple of things. There's something called a sunk cost. And sunk costs are expenses that are paid for, but they have nothing to do with whether you do the project or don't do the project. So let me see if I can add an example. So if you wanted to build a new building and you went to an architect and you said, look, I need to know what this building's going to cost me. And you go through the process and you create the building plans, right? And when you're done with the building plans, you find out that you were willing to spend 10 million, but the building that you want is going to cost 15 million. Well, you may decide not to do the building because you don't have enough money. But do you still have to pay the architect for the plans? And the answer is, of course. Now, do we use these costs as part of the project, or do we ignore them because they're already spent money? And again, it is really a company-wide kind of a decision. Different companies will include it in the cost of the project. Other companies will not. So what does that mean? If the company includes it in the cost, then that project is going to have to create more value for it to be a good project. On the other hand, the value of the project only occurs if we actually do the project. So the sunk cost not being included is also a viable kind of a decision, if you will. So again, this is one of those things in academia where when you get to another company, or if you're making this decision for yourself, you get to decide, right? As long as you always do it the same way, then it's okay. What about allocated costs, such as overhead, right? Some people say that you should ignore these because they're fixed. Again, it is up to the company to decide what they want to do. And as they mentioned here, from time to time, the overhead might actually change, right? Fixed means fixed as far as I know right now, right? It doesn't mean that the cost isn't going to change on down the line, because it could. So, again, most of the time, I would think you would include that in your cash flow forecasting. What happens if you create a new product, right? So I believe Pepsi did this not all that long ago. When they came out, I don't know if you remember this or not, but they came out with a product called Pepsi Clear. The idea was this will get new customers to quit drinking Coke and Dr. Pepper and all that. They'll start drinking this Pepsi Clear. The problem is that didn't happen. Some people moved, but more people quit drinking the old Pepsi and started drinking this new product. So what happened was, even though this product had lots of sales, a majority of the sales didn't come from new people. The sales came from their current customers. So cannibalization is when you eat into a current project, and at its expense, the new project looks good. What about excess capacity? If you're thinking about doing projects, one of the questions you need to ask is, do we need more plant and equipment? So is the use of excess capacity free, right? You have a warehouse that you're not using, and now you're going to put something in there, right? Well, you actually have some alternative uses. This is really a question on opportunity costs. Excess capacity is something that lots of companies, especially in recessionary times, have to deal with. What do you do with this extra space that you have? If you don't think you're ever going to recover from a recession, you should find somebody that will use that asset. Could be you, or it could be you could rent it out to somebody else or sell it to somebody else. But if you think you're going to come out of the recession, you don't want to sell off or put somebody in that asset And then when you get better, you just can't kick them out, right? So again, the idea is we want to understand opportunity costs when we're making choices. And finally, we need to understand something about financing, right? What are the costs associated with it? Well, we have dividend payments, are the payments that go to the people that give us common stock kinds of money, interest payments, principal payments, right? We need to reflect this cost. Where do we do that? Now, we've talked about this in previous videos. The discount rate in capital budgeting is the average cost of financing, right? So we really know what that cost is. So it really isn't a big question. What we don't want to do, though, is we don't want to include interest expense in our cash flows. Because if interest expense is part of cost of financing and it is in the discount rate, we're already taking it into account. So we also don't want to reflect it as an expense. So when we looked back at this item before, you can see here's operating income. We have some depreciation is in there, but you notice there's no interest here. That's because interest is ignored in the cash flows. It is taken care of in the cost of financing. So again, that's the end of this video. I hope you like these videos. I will talk to you soon. Bye-bye.